Oops.
Hi, this is Marty Eisenstein.
Hi, Marty.
Hi, Marty. How are you?
Hi, sorry I'm late.
No problem.
Leo, I just sent a bio for Jamie and me by email
Okay.
to you so you can read it. I don't think I had sent it previously, so if I had, then use the one I had sent previously.
Okay, which I can't find.
Okay. Can you find my new email though?
I'm looking.
Okay.
Well, good afternoon, folks. Welcome to today's webinar, Microsoft webinar. Today we're talking about something which many people may not realize should be a growing concern for them. It's sales tax on the materials that you produce that may be imposed by the places to which you send that material. So today we have Marty Eisenstein and Jamie Zoll from the law firm of Brann and Isaacson in Lewiston, Maine, and they're going to be talking to us about some of the ramifications of the recent changes to sales tax, or the ongoing changes to sales and tax laws in the wake of the Supreme Court's Wayfair decision. Just to give you a little bit of information about the company, they were the counsel to Wayfair in the Supreme Court case, and have litigated many other noteworthy cases throughout the country. Of course, they've also handled audits and proceedings in virtually every state on all the state and local tax matters, and have advised over 100 companies addressing the challenges of state and local tax compliance, including internet sellers, print producers, and publishers. Jamie and Marty regularly make presentations and write articles on various state and local tax issues, from sales tax, income tax, to gross receipts tax, as well as tax on direct mail materials. So obviously, the folks we are privileged to have with us today are extraordinarily qualified to speak to us on the topic, and we look forward to hearing what they have to offer. If we run a little bit over today, we ask everyone to stay on so that we'll have a chance to ask some questions. But without further delay, Marty, Jamie, please take it away.
Thank you very much, Leo. That was a very kind introduction. Even my mother would not say so many nice things about me, so thank you. So this is a complex subject, and we're going to try and make it easy, but I believe in the rule of three, and in that regard, there are three takeaways that you should get from this material. Despite the title, what hasn't changed is that most direct mail material services are taxable. There's a myth out in the industry that some companies have that because they're providing a service, whether as a printer or another mail producer, a mailing house, that they're not taxable. Just not the case. Every state treats the sale of printed direct mail materials as taxable, and some of the very services that you use to produce direct mail materials are taxable as well. So number one takeaway is beware of the sales tax. The second one that makes it a very significant issue for the audience is that in a post-Wayfair world, you have obligations as a mail producer that you didn't have earlier. So in the good old days, there was a physical presence test through a case called Quill. So where only the largest printers, the Quads and what was then our Donnellys of the world, would have nexus in every state because they had sales representatives and other physical presence in every state, and therefore they were obligated to collect tax in every state. What has changed as a result of the Wayfair decision is a concept called economic nexus. So If your sales exceed a very small threshold in a state, you're subject to sales tax collection obligations. So those are the first two takeaways. Now that we've given each of you heart palpitations, the third takeaway is that there are ways to mitigate your exposure. And what Jamie and I will speak about are those ways as well. So on to the slides. There are a number of slides here. So this will be my section, and I'm going to cover as the first slide indicates, slide 3, that we're gearing this to commercial mail producers and mail houses. And what has changed since I've been in the business is that the bright line between printers and mail houses is not quite so bright, and it's somewhat blurred. There are many mail houses that do printing, or at least purchase printing for resale to the postal users. So this is a subject that should be paramount for both printers and mail houses. Some key concepts. There are 45 states in the District of Columbia that have a sales tax. Every state with a sales tax has a use tax, and retailers have a duty to collect sales and use tax and remit that sales and use tax in every state where the seller has nexus. And if they don't collect the tax, which isn't here, the retailer itself is liable for the tax. And this is a particularly gotcha game, in the sense that if the retailer doesn't collect the tax, it's not its tax obligation in the first place, unlike an income tax, where it's, the company that earns the income has to pay tax on it. And they're the true taxpayer. In a sales tax, the true taxpayer is the purchaser. So if a retailer doesn't collect the tax from the purchaser, it's potentially liable not only for the sales tax, but also for penalty and interest on money it never had in the first place. So it's a double, if not triple whammy, if you don't proceed according to the rules of the game. So a company can have either economic nexus, that means mere sales without a physical presence, or it can have a physical presence. Either one is sufficient to create tax obligations. As I indicated before, a purchaser is liable for the use tax on its purchases. It's also liable for the sales tax if the seller charges a sales tax. The only exception to that rule is if the purchaser demonstrates that there is an exemption. And both Jamie and I will talk about the 11 states that provide various forms of exemption for direct mail materials. Some of them apply, some of them don't apply, as well as there are other exemptions for nonprofits, nonprofit purchases, or if a mail house is purchasing from a printer, there would be a sale for resale exemption. We'll talk about that in a couple of minutes. Every state that taxes the retail sale of tangible, every state taxes the retail sale of tangible personal property. In other words, all 45 states and the District of Columbia tax the sale of TPP. That means tangible personal property unless the item is exempt. And tangible personal property is taxed not on where it's sold or produced, but on where it's delivered, used, or distributed. So in the case of direct mail materials, that means where the materials are sent. So the most important concept and one of the important takeaways is every state treats the provision of direct mail materials as a sale of tangible personal property, and the printer and the mail house potentially is treated as a seller of tangible personal property, and possibly ancillary services like list rental, merge purge, and other related services. A mail house can both be a seller and a purchaser. It can have a dual role. And an important concept is that a producer, whether a printer or a mail house, must obtain an exemption certificate or resale certificate from its customer unless it is, and if it doesn't, it will be liable for the sales tax or use tax. A mail house or other producer that does not do printing may be both a purchaser and a seller to the ultimate postal user, meaning it could either be an agent or it could be a reseller, and you have to define your role. If a mail house is simply an agent for the postal user, then it has no obligations as a seller, but needs to make sure that the postal user is fully compliant and paying the sales and use tax. Some key concepts regarding services. There are only a handful of states that tax services in general, and several states tax selected services such as shipping and handling. Some states tax list rentals, and a handful of states tax data processing services. While tangible personal property is clearly sourced to the place where the material is mailed, in the case of services, the rule is not uniform. It can be taxed where the benefit is received, sometimes where the customer is located. So that determination of sourcing is done on a case-by-case basis. Another very key concept, and we'll get back to this again, is that if a bundle of taxable and non-taxable products and services is sold at one price, and many of you probably sell in one price as opposed to itemizing the different products and components of the products and services, if it's sold for one price, the whole package is taxable if a major component or a principal component is taxable. So what we'll talk about again and again in this webinar is that a key concept is to itemize the pricing of the different components to mitigate or limit the amount of the tax. The economic nexus standards adopted after Wayfair don't change the nexus profile of a producer that has physical presence. In other words, the fact that you have a physical presence and may have had a physical presence in a state doesn't change your tax obligations. If anything, the fact that you have both an economic nexus and a physical presence may provide an opportunity for you to register silently, and we'll talk about that in a moment, register silently and not necessarily cast a spotlight on the fact that you haven't been collecting sales tax when you had a physical presence. Exemptions are very important in this area. There are 10 states in the District of Columbia that exempt the distribution of promotional materials and some direct mail materials, and all states provide an exemption for sales for resale. But the critical point is that the devil is really in the details, because the taxability of items and the exemptions for items turns on each state's law, and one has to review those laws very closely to see if the exemption applies or what is necessary to enjoy the benefits of the resale exemption. In turn, the kind of certificates that a seller would need to obtain from its customer in order to make sure it's not subject to a tax turns on the state's laws. So what will be very important for you to take away from this webinar is to determine when you need exemption certificates, and if you do need exemption certificates, to make sure that you are obtaining those exemption certificates. With that, I would turn over the microphone to Jamie to talk about other concepts or essential concepts concerning taxability of direct mail materials. Jamie?
Great, thank you, Marty. And I think we are good to go now. It doesn't want to apologize. Oh, there we go. Okay. So to just kind of go through some, like Marty said, key concepts in the direct mail world, and particularly in the lead up to in the background of the Wayfair decision. Direct mail is generally just a, I wouldn't say just, but it is a tool that organizations use, your customers use, both to market and to solicit potential customers in various states, but also to share additional information in the non-promotional world. And often it's, mail that is sent not just to, here in Maine or in Nebraska or Oklahoma, but it's, material that's distributed on a multi-state level to customers throughout the United States. The real critical impact of the Wayfair decision is that you as mailers, as print shops, and your customers, because of the nature of direct mail in how it is distributed, it opens up your companies to potential exposure on a multi-state basis and a multi-level basis. And I'm sorry, I apologize. My slides don't seem to be working. Let's see if we can. I'll talk through my slides and I'll work through on the side, and I apologize for the technical difficulties. There we go. So
Jamie, you want me to manipulate? What slide are you on, Jamie?
I am on, but I don't seem to be able to move the slides back and forward. So right now, if we can just slide number 14, if you don't mind, Marty, I would appreciate it. As you all know, so what we're talking about is the concept of direct mail. So this would be, it could be catalogs, it could be flyers, it could be other information cards that you would get, from a dentist or from your banking company. But the concept of direct mail is that, as you know, it's mail that is printed in large batches and sent to large groups of people. And the recipients are typically designated. Like Marty mentioned, there's usually a mailing list or a customer list that identifies who is going to receive the printed mail that is sent out. And typically, direct mail has been treated like the mail that you produce as a mailer has been treated as tangible personal property. You're going to be selling that piece of mail or that piece of direct mail. Some states do treat it as the sale of tangible property combined with the provision of printing services or other letter shop services. But the majority of states do treat it as the sale of tangible personal property altogether. Moving on. Prior to the Wayfair decision, there were certain concepts that really governed the, I'm now on slide 15, the direct mail world. This concept, as Marty has mentioned a few times, of physical presence, that at least for printers and for letter shops and mail houses, this was, the base of where you had your printing operations. And did you have sales reps in multiple states? Your base of physical operations. And as a printer, your exposure in the pre-Wayfair state or as a letter shop, your exposure was, in the locations where you had physical presence, where you had, persons or property or plant in a state. Direct mail has typically always been, and historically, at least through the auspices of the Streamlined Sales and Use Tax Agreement that we'll get to in a couple slides, and a number of the other large states governed by destination materials. So the sale that occurs, your sale of direct mail, is not sourced to the location where you print or produce the direct mail, or the location where you send it off on its way into the stream of commerce, but it is measured by what we call destination sourcing, the location of where the mail is sent, the recipient location, or the destination sourcing location. Because the printers, the letter shops had typically, at least the smaller ones, I'm not talking about the Quad or our Donnellys, had limited physical presence in the locations of where their operations were based, and your customers, the catalog merchants or the banks or the dentists or whatever your customer industry may be, had a limited physical presence. The obligations of printers and the obligations of catalog merchants before Wayfair to collect sales taxes were limited. They were not subject to 45 state and DC analysis based on destination location. Your exposure was to the extent that you produced mail in, say, Illinois, and it was delivered to destinations in Illinois, and your customer had a physical location in Illinois, all three of those things lining up. That was the exposure of potential obligation to collect sales or use tax in the pre-Wayfair days. And states, although they often had provisions in their statutes or regulations that solicitation by way of catalog could create nexus, because of the prior Quill decision and the lack of physical presence of your customer, the catalog merchant or the bank or the dental shop, did not themselves have physical presence, i.e. nexus, in those states. States found it very difficult to both enforce, and also they were precluded from doing so because there was no constitutional nexus. In the pre-Wayfair days, when we were talking about multi-channel retailers, I'm now on slide 16, companies that made use of direct mail on a multi-state basis and themselves also had multi-state presence, those were typically the enforcement target of states, looking at companies that had that brick and mortar and could be subject to potential sales or use tax liability on their distribution of catalogs in those same states. So, for example, you're looking at a retailer that has a store in New Jersey and also distributes catalogs in New Jersey, whether or not you as the print shop produced those catalogs in that one state. That was the typical enforcement target. Less so on the print shops, the mail houses, but more so on the retailers. As states were unable to address or to get at, if you will, the taxes that they felt would have been due on direct mail, they started to shift their focus away from the retailers and the catalog merchants and the banks and the other direct mailers to the printers who were producing the mail as a way of identifying or getting at kind of the base of the direct mail operations. The kind of workaround in the pre-Wayfair days was to secure what we called no nexus letters from the catalog merchant. So you, the printer, would secure these letters, basically attestations from your customers that they do not have nexus in Arizona or New Jersey or whatever the state may be. They did not have physical presence and therefore no nexus. And because your customer did not have nexus in the states on that letter, they could not be subject to a tax obligation. Now, remember, as Marty said at the beginning, the obligation, the person who is responsible for paying the tax is the purchaser. And in the direct mail world, that purchaser is your customer, the direct mailer, the catalog merchant or the bank, et cetera. And if those purchasers don't have nexus in a state because prior to Wayfair they didn't have physical presence, then the no nexus letter served as a way to assert to states that they could not be subject to any sort of use tax or sales tax obligation on the direct mail that was distributed into that state. Moving on, under the Streamlined Sales and Use Tax Agreement, the S.Ct. is an organization, a commission, if you will, of 24 member states. That in the concept has been to create kind of a uniform set of definitions that will be used in states and a uniform set of certificates for the members. Under the S.Ct., direct mail is printed mail material, as we talked about, that is distributed in bulk to a mass audience in multiple states based on a mailing list. Another key factor is where the cost of that item, so the cost to produce each individual piece of direct mail is borne by the catalog merchant or the direct mailer, and is not borne by the person that receives the direct mail at their house. We're not talking about multiple items that are sent to the same address, but rather the same item, the same piece of mail that is sent to multiple addresses. I mentioned there are 24 member states of the Streamlined Sales and Use Tax Division, or rather 23 full members. Tennessee is coming on board as of next year, and next year we'll adopt the S.Ct. definitions of direct mail. The other component of the S.Ct. is really the universal set of sourcing for direct mail. We'll get to that shortly. Non-member, moving on, Marty, non-member states, really these are the big states such as California, New York, Florida, Texas. They are not members of the S.Ct. And these states have different definitions of direct mail. They may or may not use that exact phrase. For instance, California uses the phrase printed sales messages, or New York uses printed promotional materials. Florida has a particular provision for cooperative direct mail, and by that we mean a piece of mail like your Valpak coupon package that has multiple advertising and marketing inserts from multiple different companies that are all sent in a envelope to one address. It could be that you distribute thousands of those envelopes, but that is the concept of cooperative direct mail. And some states like Illinois have no specific definition for direct mail, but look to just their concept of tangible personal property, as we said at the beginning, thinking of anything that is purchased, printed, and sent out as tangible personal property subject to tax, and looking at the sourcing and the treatment of tax from that angle. We have a handful of states also that, as I mentioned earlier, look to direct mail as a combination, as a bundle, as Marty referenced. That is the printed materials, so the direct mail that actually gets printed and produced, combined with the provision of various services, printing services, letter shop services, other mailing or advertising services. And to the extent that it is promotional, or what we have otherwise called other direct mail, so not advertising, may treat the package that you sell as a bundle of combined printing and services, or may look to the separate components of each. And that just raises a quick clarification, moving on to the next slide, Marty, that many states, including the S.Ct., do have a breakout of direct mail between advertising and promotional direct mail. So think of your catalogs, your flyer inserts, your 25% off coupon cards that get postcards that get sent out. That would be advertising and promotional direct mail. The effort to sell or to encourage a customer to buy a product. And then other direct mail. So, it's the very helpful definition of anything other than promotional direct mail. But what we're talking about with other direct mail really is less of the solicitation and more of the information sharing to multiple customers. Again, still within the concept of a single piece of mail that is distributed to multiple different addresses at the same time, just not solicitation. And whether or not what you're printing and producing is advertising or promotional direct mail or other direct mail could have a big impact on exemptions that may be applicable, sourcing rules for how to determine which location the mail is sourced to for tax purposes, or ways in which the combination of printed messages and services are treated for purposes of figuring out what is the taxable item that you are selling. Typically, and moving on to slide 20, the direct mail is treated as taxable unless there's an exemption. There are 10 states in DC that have a specific exemption for promotional direct mail. There is one state, Pennsylvania, that also has a potential exemption. It's a limited one for other direct mail. But by and large, direct mail is treated as a taxable item that you are selling. There are some states where your ancillary services, such as advertising or letter shop services, are treated as part of that item of tangible personal property that you sell, and are not separately taxed on their individual service by service level. There are some states where if it's other direct mail, you may look to the taxability of those ancillary services. Minnesota is a good example for determining whether or not advertising or letter shop, advertising in this context meaning the services of helping prepare the copy or generate the copy that will turn into the direct mail. And then, one key aspect of direct mail that often is a question that we see is, what to do about postage. So this means, the postage to send off that individual piece of direct mail. If the postage itself is paid for, or at least billed to a postal meter of the direct mailer, meaning the catalog merchant or the other business, then no tax applies because it's a standalone separate item for postage, and all states have treatment that postage itself on a standalone billing item is not taxed. But that treatment could be different if the printer or the mailer or letter shop itself is bearing the cost of postage and then passing that charge through to the customer on an invoice and not directly billing that customer's postal meter. Last one more slide, as we've kind of talked about, this is now slide 21, the typical rule among all of the states, this was pre-Wayfair, has been that direct mail is taxed based on the destination location, meaning the place to which the direct mail is sent. The SSUTA does have particular rules for determining where that destination location is, but as a general matter, if you as the printer or the mail shop have the list, the customer list that you're using to generate or to issue the direct mail, and you're responsible for initiating that distribution, then, and you have the knowledge of where the direct mail is being sent to, then that is the sourcing rule, the general sourcing rule for printers and for direct mailers. There are a handful of states that have historically applied the origin sourcing rule, meaning they look to the location in which your printer or your mail house or your letter shop initiates the mail, so the place from which you send it. Ohio is a notable example of that origin sourcing, but in the post-Wayfair world, as Marty will talk about later, that origin sourcing is not only getting complicated, but it's also going by the wayside. We have used the phrases sales tax, use tax, where a sale occurs, where a use occurs, and this the terminology becomes relevant because in most states the sale itself occurs, where the title passes or where the sales transaction is executed, if you will. So, where the contract is negotiated or the contract is executed, where the title passes from you to your customer on that direct mail. A use occurs if, a purchaser brings an item of direct mail into a state, or in this concept in direct mail, causes a piece of direct mail to be shipped or distributed to that state, and there a use occurs of that direct mail. States have looked to whether the catalog merchant or the direct mailer is the owner, if you will, of direct mail that's delivered into the state, and as the owner of that direct mail, the direct mailer, the catalog merchant is using that direct mail in state, and therefore may be subject to tax. Again, this is a different concept than nexus. It's looking more to is the item itself within the purview of the state for taxation. With that, I'm going to turn it over to Marty.
Thank you very much, Jamie. If I can get the control of the screen, please, Michelle. I think I can turn it. If not, then if you would please go to screen 23, Michelle. Great, thank you. So on screen, what I'm going to be talking about in this portion is the Wayfair laws. So on June 21, 2018, the court issued its decision. It was a close decision, 5-4 decision. I sat at counsel table. I argued. I was on the brief in the case, and we thought we had a good chance, but we didn't win. It was a tough case, split decision. We had against us 42 states and the Solicitor General, so we felt we had made a really, really good argument in court, but we didn't win. So what has resulted as a result of the Wayfair decision is that all but 2 states, 43 states and the District of Columbia have adopted statutes that are called Wayfair laws, and we list on slides 24 to 26 the different shapes and forms and varieties of those laws, and just you really need a scorecard to be able to tell what is the test in each state, and it changes over time, which is a real interesting issue. So on these slides, as you leaf through the slides, I won't, talk about it, individual states, but I'll talk about the 5 variations of the theme. The first variation is a pure South Dakota type statute where if your sales in the state are greater than $100,000, or you have more than 200 transactions. An either or proposition, you're required to collect and remit the sales tax of that state. So for a mail producer, that means if the dollar amount of the tangible personal property, catalogs, other mail materials are distributed in the state exceed $100,000, there's a gotcha game and you're subject to the tax laws of that state. So Illinois, South Dakota, Arkansas, Hawaii have that form of statute. Another type, the second type, is mere sales alone established nexus, not the number of transactions. In Alabama, it's 250,000. California is 300,000 and 500,000. Sorry, and Idaho is $100,000. The third variety is that you have to have both sales and transactions. New York and Connecticut are those kind of statutes. In New York, it's $300,000 of sales and 100 transactions. It's possible that for some direct mailers, for some producers, they may have fewer than 100 sales, and that's deemed a transaction in the state that for distribution of materials, and therefore they wouldn't fit within the New York statute. The fourth variety is a changing standard. So in Connecticut and Georgia, at one point in time, the standard was much more difficult to meet, meaning you had to have more dollars and more transactions. And since that point in time, the state has lowered the threshold. Connecticut is of that nature, Georgia is of that nature, and Massachusetts is of that nature. And generally what has happened in the state and local tax field is there's a race to the bottom, meaning the states want to grab more and more money, so they dilute the standards. So just about every company would be subject to the economic nexus standards, aside from the very, very small companies. And that wasn't really their purpose. The U.S. Supreme Court blessed a standard in South Dakota which is a much less populated state as compared to New York or Illinois for that matter, yet Illinois has the exact same standard as the standard in South Dakota. So I always thought that things should have been relative, and however, they're not. The fifth type, which is a real rub, is the states that have home rule jurisdictions. And without going into elaborate detail, there are some states, there are 6 states that provide that municipalities can adopt their own tax systems and can require companies to register not only with the state tax agency, but also with the local tax agency. The most prominent states in that regard are Colorado and Louisiana. Colorado, I think, has over 70 home rule jurisdictions, some as small as Golden and some as large as Denver. And what it basically means is a company could have tax obligations both in the state and at local levels, and the laws can vary. So that which may be taxable in the state may not be taxable in the home rule jurisdiction, and vice versa. The good news is that thus far, Colorado, with all but 1 or 2 exceptions, the home rule jurisdictions do not have an economic presence test. It's a physical presence test. There are some outliers, though, that home rule jurisdictions that have sought to enforce an economic presence test. I won't go into all of the details because that's well beyond this webinar, but the point is that in order for a company to determine its potential tax obligations, it really needs to closely analyze each state's sales. So if you could please go to slide 28, that would be great. So a fundamental principle is that if a producer has nexus with a state based upon either an economic presence or physical presence test, it is required to collect tax on all direct mail materials delivered into the state and taxable services sourced to the state. And in that case, printers and mail houses should require, if they do have a nexus, should require exemption certificates based on the laws of the state in which they are located. So I was able to move it. Thank you. So on slide number 20, sorry, going the wrong way. Oh, sorry. I have a spastic mouse. On slide number 29, I just focus on the fact that there has been recent enforcement activity against printers and mail houses in 3 states, Colorado, Hawaii, and Tennessee. The good news is that thus far, the states have been fairly silent on those issues, on the issues of taxation of direct mail materials. But it is like a sleeping bear. At some point, the bear will come out of hibernation, and states are always tax hungry, so they will look for other sources of tax, and the vulnerability will be in the direct mail industry for those companies that haven't followed the Wayfair laws. Could you please go to slide 30? I'm good, thank you. So the solution for a direct mail producer that has nexus is to determine its profile. And what we commonly do for clients is we compile the findings in a matrix on a state-by-state basis. And what you determine in order to assess the potential risk and the exposure in a state, you have to first determine whether there is either an economic or physical presence. And the economic presence would be based upon the sales in the states where direct mail materials are sent and where the benefit of services are received. Once you've determined, and there needs to be a determination made as to whether the company has a physical or economic presence, the next step is to determine the taxability of direct mail services and products, as well as the exemptions that may otherwise obtain. Would you please go to slide 31? So what a company should do is develop an action plan to make sure that it is not hit by tax exposures in another state. So that action plan would consist of determining whether or not it should register for sales or use tax purposes or enter into a VDA. A VDA is short for voluntary disclosure agreement. And a voluntary disclosure agreement generally limits the exposure to a certain look-back period, to a certain period prior to the date of registration, and it waives penalty. And depending on the state, you may want to seek a VDA, you may want to silently register, or you may want to change your nexus profile so that you don't have that taxability in the future. You clearly, as part of that exercise, want to determine whether there are any exemptions for direct mail materials or for your customers to make sure that you obtain all of the exemption certificates, both for past sales as well as for future sales. If you could please go to slide 32, Michelle. Thank you. It's going to be important for you to identify the exemption certificates by the kind of exemption certificates you need, by the type of certificates, and that which the state requires. On slide, I identify this as slide 38, it should be slide 39. We talk about the different types of exemption certificates. What my clients generally do is pre-populate the exemption certificates, filling in the information disclosed there, and send them to their customers, and determine other key factors so that they make it easy for their customers to submit those kind of certificates. And with that, I'll turn over the mic to Jamie to talk about examples of specific state exemptions.
Great, thank you, Marty. Work again, going on to slide 34, Michelle. As we mentioned earlier, there are 11 jurisdictions that have exemptions. By and large, these are typically for promotional direct mail. And they kind of break down into three categories, if you will. There are many of the non-SSUTA states, so California, New York, Pennsylvania, as we note, embed their exemption for promotional direct mail right into their state statutes by way of California's printed sales message exemption. There are some other states that do not have a statute or a regulation that particularly addresses direct mail or promotional direct mail, but by way of court decisions or administrative opinions from those states have concluded that that the items, the direct mail items that are delivered into the state or that are directed to that state by a catalog merchant or by some other business that itself has no physical presence in that state, does not consider a use of that item in that state subject to tax. You'll see this in particular in states like Michigan, that in fact, Marty litigated that case, Illinois, where there have been opinion letters. The thing to just call to your attention, although states like Illinois and Virginia have consistently taken the position in position letters that direct mail distributed into that state is not taxable use by the merchant in that state, those decisions are not binding. But there is a long history in those states of consistently reaching the same conclusion. And so for those states treat the distribution of direct mail as not taxable in that state. There are some other states, a larger number of them, that treat inserts, so just like a flyer that gets slipped into a newspaper or a magazine, as exempt as a state policy to encourage the reading of newspapers and magazines. Anything that gets slipped into there can be treated as exempt as well in the states that are listed on slide 34. I'm just going to quickly run through a couple of examples of the exemptions that are available for promotional direct mail. And moving on to slide 35, Michelle. And this really highlights what Marty said quite at the beginning, that with the exemptions that are available, particularly in the larger states, the devil really is in the details of the exemption. So the first part in New York with its promotional materials exemption is that what you're looking at is at printed promotional materials. It is broadly defined to include things like catalogs or mailers, free gifts. If you go into any kind of tourist shop in New York City and get a map of the city with, you find these businesses or find the Statue of Liberty or the Chrysler Center, those type of free materials are also included in the very broad definition. It also includes such ancillary items as the mailing list, your customer list that is being used to distribute the mail any of the ancillary services related to creating promotional direct mail, and shipping and handling charges. This can include not only the postage on the direct mail, but also any freight charges that may develop in transmitting the pallets of direct mail from the print shop or the letter shop to the postal office or the post service that you're using. But the key factor with New York, and moving on to slide 36, is that the direct mail itself, at the end of the day, when it's put into the stream of commerce, has to be shipped out by the U.S. Postal Service or a common carrier. Those are typically, UPS or FedEx. If you use a contract carrier, the exemption no longer applies. We highlight two administrative decisions from earlier years, but just as of last week, another decision came down in New York reiterating that to the extent that promotional mails, which may otherwise hit all of the elements, are delivered to New York residents by way of contract carrier, so not one of the big common carriers, then the exemption no longer applies. And the last thing is that element is that the distribution list and the end customer cannot be charged for the direct mail that is received. And that's kind of built into the S.Ct definition, and the New York definition of the exemption is similar, that these have to be items that are shipped for free to end customers. So to the extent that it's a magazine that is sent around or other direct mail that's subject to a membership fee, a subscription fee, that no longer qualifies as promotional materials that are exempt in New York. Similarly, in Pennsylvania, moving on to slide 37, what we're looking at is in particular the details in Pennsylvania, and actually I'm going to move on to slide 38, Michelle, is that Pennsylvania's shipping requirements are even narrower than New York. You have to use the post office in Pennsylvania in order to distribute the mail, or the exemption is broken. The other factor, and this is one area where we see trip up more, or the breaking of the exemption more, is that the underlying materials used to prepare the direct mail, such as the paper or the ink, have to be provided by the printer. If they're provided by the customer, such as the catalog merchant or the other businesses, that exemption no longer applies. So all of the underlying materials have to be provided by the person producing the direct mail. I do want to just take a few minutes to highlight on slide 39, Michelle, the exemption certificates that are common among the states. The Streamlined Sales and Use Tax Certificate covers all 23 of the 24 member S.Ct states. And through the use of that certificate, you can identify either that the particular member state, such as Wisconsin or Ohio, has a exemption for direct mail. You can also use it as a resale certificate or even as a direct pay permit. By that I mean, your customer, the catalog merchant, is taking on its own responsibility for assessing, reporting, and remitting any potential taxes that may be due on the direct mail. And the other similar form that covers multiple states is the multi-jurisdiction exemption certificate. For each of those two certificates, because they cover multiple states on the same single certificate, is that you want to make sure that your customer, the catalog merchant or the other company, fills in all of their registration numbers for each state in which they're registered. We've been informed that the multi-jurisdiction exemption certificate can no longer be used in place of a no nexus statement where it was before. So in this post-Wayfair world, where your customers are likely subject to nexus, or may be subject to nexus in multiple jurisdictions, you want to make sure you get their permit number on each state's line on that certificate. The non-SSUTA states, such as California, New York, that provide exemptions have their own exemption certificates for promotional direct mail. And you just want to make sure that you're using the correct certificate and that it's completely filled in, signed, and dated on the bottom. There are some other states where they don't have exemptions for promotional direct mail or other direct mail, but do allow the purchasers to issue state-specific self-assessment permits, self-assessment certificates that are not formal direct pay permits, which are documents authorized and issued by the state to that vendor, that business, but are statements of self-responsibility on a state certificate saying that the purchaser himself or itself will be responsible for those taxes. And with that, I'll turn it back over to Marty for the last few items.
So I'm going to talk about the taxability of cost components. I apologize that we've run over and haven't left a lot of time for questions, if any. So the first concept is that, and we've already talked about that. Why don't we move to the next slide, slide 41. So the notion of taxable, excuse me, slide 42, sorry. So the one key concept that you should keep in mind, squarely in mind, is that one bad apple spoils the bunch. By that I mean, if you price a bundle of services, think of a cheese board platter that's sold by a cheese board with a cheese, a wedge of cheese on it. New York had adopted this so-called cheese board rule that said that because the cheese board itself is taxable, the whole bundled price for the cheese board with a wedge of cheese on it is taxable. If, however, the seller had said, you can buy the cheese for X and you can buy the cheese board for Y, the seller would only have to pay tax and collect tax on the Y. So different variations on that theme are that if the non-taxable product in the SSUTA states is less than 10% of the cost, or in Texas less than 5%, then the whole bundle is not taxable. But generally, if you can please move to slide 43, the most important principle, the cardinal principle, is to separately price and invoice separate charges for different services and products. You're doing a service to your customers by separately and itemizing prices because you reduce the tax bill for your customers. Insofar as separate price, different services, separate pricing, for example, shipping and handling. So oftentimes, if you separately price shipping, it's not taxable. But if you make it part of the bundle price, it's taxable. Similarly, if you separately price shipping and not include handling, it may not be taxable. If we can move to slide 44, where we can discuss some other services that mail houses and some printers provide. So a question is whether or not prelim materials, photographs, design, prepress, and copy, are they taxable? The key question is how they're transmitted by the printer or the mail house and who prepares the materials. There are some arguments that it's not tangible personal property, depending upon the vehicle for its transmission and exchange. And in this day of electronic transmission of pre-press designs, et cetera, there may be a good argument for not taxing it. Generally, manufacturing charges on a printer's bill, the printing, binding, collating, that's all generally taxable and should be separately charged as opposed to some of the other services. Michelle, if you could go to slide 45, that would be great. On slide 45, we talk about other services, such as mailing services, collating, sorting, addressing, and metering. Generally, it's not taxable if separately charged. Some states that may tax it, but those are definitely a minority of states. Similarly, sale of names or rental of names from a mailing list is not taxable in most states because it's treated as a service. Some states tax information services and they may be taxable. DC is a good example, and Texas is another example. Finally, if we could go to slide 46. So on slide 46, we deal with two other types or categories of charges. The first category would be shipping charges. So as Jamie said, postal charges that you pay to the post office shouldn't be taxable, but sometimes printers, oftentimes larger printers, but it doesn't have to be a large printer, will charge a fee for what they call bulk shipment charges. And what those charges are just the discount that they're able to deliver to their customers for being able to load a truck with several customers' products so that they can ship to one geographic area or one post office. And oftentimes printers will assess a charge. That should not be taxable, but the charge should be clearly specified, clearly itemized, and separated from the printing charge itself. Similarly, data processing charges, the manipulation and management of data to optimize mailings, to target mailings, should not be taxable. It is taxable in a handful of states, such as Texas, which does tax data processing charges. But in most states, it's not taxable. But again, the key is to separately itemize. And with that, we conclude our remarks. Let me just conclude by saying that hopefully you've gained enough information from this webinar to deal with the three takeaways. One is that many of your products will be taxable. Two is that you may be subject to another state's laws. And three is to make sure you develop plans before the tax man cometh to deal with the potential exposure that your businesses face. With that, I'm happy to take, Jamie and I are happy to take any questions you may have.
Well, Marty, I think at this point, people are probably pretty well convinced that this is a serious issue. I'm happy to see that you reinforced the message for a long time about separately stating your postage and delivery charges if that's applicable. We do have two questions. The first one is, if our client distributes print promotional material to multiple states, do we need to get an exemption certificate from the client, or only do we need from the client only, or do we need something from each state that they mail to? And are there specific forms we should keep on file?
So Jamie, you could speak to this, but if you go to slide 39, Michelle, if you could put on slide 39, that's a good starting point.
You may need to get several different certificates from your customer to address all of the various states into which they're shipping the promotional direct mail. But you won't need a certificate from both the customer itself and a separate acknowledgement from the state. What we mean by certificates and the exemption certificates is a document between you, the printer, the mail shop, and your customer confirming that what is being sold, the direct mail, is exempt in that state. So for instance, if your customer is sending catalogs up and down just the East Coast, the certificates that you're going to want to get are the New York exemption certificate, the DC exemption certificate, the Virginia exemption certificate, the Pennsylvania exemption certificate, and then also the streamlined sales and use tax certificate. These, the certificates that you want are going to be the ones that are acceptable or that are authorized in each of the distribution locations, the distribution states for that customer, but it's executed and issued by the customer itself.
Okay,
that would be the, yep.
So we have another question regarding thresholds. If the client is in one state and we mail to several states, is each piece of mail in each state considered a transaction? if the recipient isn't paying, is the value of the piece added toward the threshold?
I'm not sure I understand the paying question. The threshold is measured in each state. There's only one transaction. That's the sale to the customer. It's not a separate transaction per state, but that counts as one transaction in each of the states where the mailing occurs, where the materials are distributed. And so what you have to do is measure the dollar amount of the sale, the proportion amount of the invoice that goes to a state. Say Illinois, if 10% of the mailings are directed to Illinois and the bill is $1 million, then you're subject to the Illinois threshold of $100,000. But that would count only as one transaction for Illinois threshold purposes. If the recipient doesn't pay the tax, doesn't pay either the tax or the amount of the receipt of the sale, it still doesn't matter insofar as the nexus threshold.
Okay. Another question, is the mailing of financial documents such as bills and bank statements part of this sales tax discussion and the Wayfair decision?
It's a very core of this discussion. Wayfair didn't deal with the mailing of printed financial materials, financial documents, but what is good for the goose is good for the gander, meaning Wayfair was selling furniture, and Newegg, which was another one of the litigants, was selling computers, and Overstock, which was the third litigant, was selling various items like furniture or appliances. But regardless of whether you're selling appliances or you're selling furniture or you're selling printed materials as a printer or as a mailhouse reseller, you're still subject to the Wayfair laws that have been adopted by each state. So you're very much part and subject to sales tax collection obligations because you're selling tangible personal property. That is the direct mail materials that are the financial documents.
Okay, that cleared up an important question that many people have had. We're getting asked if we can get a copy of the presentation or a copy of the recording. Yes, all of our subscribers will be able to access copies of the recording, the presentation, once the recording renders. So that should be available sometime tomorrow, and we'll make that available. There's a question here also. As the printer, am I obligated to register in each state that I am shipping to for my catalog merchant? As a printer, right, they asked the question that they asked. Are they obligated to register in each state?
The answer is yes, if they exceed the threshold in that state. And I can't say now without reviewing the sales by destination of the printer, whether or not that printer is subject to registering in those states. But the only way to determine that is by getting a handle on the printer's total sales and to divide the world up into those sales by the destination of the materials.
And the dog
like that one.
And I apologize. There must have been a squirrel or the postman. Speaking of which, that just drove past with my dog. But
now, if a client is self-assessing, does that help anybody?
It does, but there are certain certificates that you need to make sure that the client, to protect the retailer, the seller, that the seller is doing self-assessing.
And in those states where, as your customer, the bank or the catalog merchant prefers to self-assess, then the certificates that you want to make sure that you secure from those customers are the Streamlined Sales and Use Tax Certificate, which acts as a self-assessment certificate. The specific certificates in Minnesota, in Kentucky, and in Texas for self-assessment. And to the extent that that customer is registered in other states, other non-SSUTA states, for instance, Alabama or Massachusetts, and they have secured a direct pay permit from that state, you want to make sure that you get that direct pay permit as well. That is a separate formal document from the state. Okay.
Well, I think what we've done today is given everybody a headache, which is probably something which they need to go through. So back in the day when I was working on the domestic mail manual with postal regulations, people said that's complicated. I think this sort of makes it look very simple by comparison.
Well, that's good. And, you know, the good news also is that even if you're subject to a curfew, you can go to the pharmacy and get an aspirin. So, sorry. Trying to give you an excuse to leave the house.
Yes. Well, I want to thank both of you, Marty and Jamie, for getting us into this today and exposing some very important information that everyone on the call needs to really start paying attention to. For those of you who are on the call, trust us, this is not the last you'll hear of it. We'll be offering some more information. We'll be leaning on Marty and Jamie very heavily over the next few weeks and probably for a long time ahead of that to help our subscribers figure out what's going on. And we'll work with them to develop something else to offer to get a little bit deeper dive into what we talked about today. But until we get to that point, I want to thank Marty and Jamie again. Thank you, Michelle, for keeping the lights on. And thanks to all of you for calling in today. We'll be getting back to you with more information in the near future. So until that time, thanks again. We'll be talking to you soon. Bye.
Bye.
Thank you. Bye-bye.